In this video, we're going to model out some different price predictions for the S&P 500, and I'll share exactly how many shares you will need with their cost as of today to be able to retire purely from the S&P 500 in 2030 at these different price points. For those of you who are not familiar, the S&P 500 is an index that tracks the 500 largest US companies. A lot of these companies are definitely ones you've probably already heard about and you're familiar with. Companies like Google, Microsoft, Meta, Amazon, Tesla, McDonald's, Disney, it just goes on and on. People like investing into ETFs and index funds that actually track the S&P 500. One reason is because historically it's provided good returns to investors, but also because it's a less risky method of investing than perhaps picking individual stocks. It provides you with a diversified collection of many companies. So I just mentioned that you can have index funds and ETFs that actually track this S&P 500. If you're in the UK, VUSA, VUSA is a very popular one, and if you're in the US, SPY, SPY, or VOO, VOO are very popular also. This video is going to be a lot of fun, but just before we get started, I want to make sure that you understand that it is just for fun, and it's purely speculation. No one truly knows what's going to happen to a stock or an index or an ETF or anything like that over the next 7 years. We can only really model based on previous data and our sort of price predictions for the future, but truly no one knows definitely what's going to happen. So if anything, I just hope you enjoy this video for what it is, and perhaps it will encourage you to go and make your own price predictions or even help you build conviction in investing itself. So we're going to have 3 different price predictions. We're going to have a bear case, an expected case, and a bull case. And I'm not only going to tell you the price prediction for the bearish, expected, and bullish case for the S&P index itself, but also for VUSA and VOO. Now, the S&P 500 typically returns on average between 10 and 11% per year. I'm sure you've all heard of this number before, and this is calculated by basically taking the returns and losses over a set number of years, adding them all up, and then dividing by the number of years that you've used. But it doesn't actually account for the money compounding. I found a good example online actually to help explain why this isn't the most accurate method to use. It assumed an investor invested for 2 years. In the first year, they earn a 100% return, and in the second year, they had a 50% loss. This means by the end of year 2, using very simple maths, their return was 25%. 50% return over the 2 years, and then divide that by 2, 25%. But actually, when you look at the figures, they ended up with the same amount at the end as what they started with. So that is actually a 0% return. If they put £100 into an investment and in the first year they got 100% return, this is the money doubling. Therefore, after year 1, they have £200. Then in year 2, if they get a 50% loss, this means that the money is then halved from 200 back down to 100. So after year 2, they are left with £100, which is exactly what they started with. And this is because your money compounds using the compound annual growth rate, CAGR, which is a much more accurate way of doing things. So if you look at the compound annual growth rate of the S&P 500 since 1957, which is when they started tracking 500 companies, you'll get a percentage of about 6.27. And this is including dividends and adjusting for inflation. But according to a study done by a guy named Robert Shiller, the inflation-adjusted compound annual growth rate for the S&P 500 since 1871 comes in at 6.8%. So we're going to go with 6.8%, including dividends and inflation, because this accounts for the most data, which seems a little bit more accurate. So for our expected price prediction, and remember, we're going to do a bearish, expected, and a bullish price prediction, but for our expected case, we are going to say and assume, it's just an assumption, remember, that the S&P 500 will continue to grow by 6.8% per year. Actually, we're going to round that up and just call it 7 for some easier maths. But remember, of course, this won't happen every single year. Some years the index will go up by 20%, others it might drop by 14%, but over a long period of time, it hopefully will average out at our expected 7% per year. Now, if we look at the current price of the S&P 500 index, we can see that right now, as of today, it's $4,398.95. So if we plug this into an online calculator and use our 7% annual growth, we can see that in 2030, so in 7 years' time, the S&P 500 index should, based on this, be worth $7,063.75. Now this growth would be the equivalent of £104.68 if we're talking about VUSA, and $646.96 if we're talking about VOO. But you'll see all these figures for the different funds summarized at the end of the video when we talk about how many shares you would need to retire. For our bear case, we're going to say that the S&P 500, and therefore the entire macroeconomic situation, has a really poor time in the next 7 years leading up to 2030. So this would be going through recessions, having high interest rates, etc, etc. Basically, the 7-year period that we are modeling out is just really not very kind to investors. For our bearish case, a complete bear market. Hence why they say that investing should really be for the long term. You should invest over many, many years, decades even, because this allows you to average out the highs and the lows. If you are only investing for a short period of time, you could experience a really bad market during the years that you're actually investing into. You could have a lot of short-term volatility. For our bearish case, we are going to say that by 2030, the S&P 500 index will be at the same price as it is today. So this means the index itself will sit at around $4,400. If we're talking about VUSA, about £65.20, and for VOO, $403 per share. There are 2,555 days in 7 years. On average, a bear market lasts 292 days, and it takes 19 months to recover from a bear market on average. So it's very unlikely, based on data, that a bear market would last an entire 7 years, or would be bad enough to actually not recover and rise again during those 7 years. But of course, for this video, we are having to make some assumptions. Then for our bull case, which is always the most fun one to look at, of course, we are actually going to use an online prediction. I will link this down below, but this has come from JP Morgan, who have said the S&P 500 could reach $10,000 by 2033 to 2035. So for our bullish case, we're going to run with this. We're going to say $10,000 by 2030. This would be £148.20 for VUSA and $916 for VOO. Now for our bullish case to happen, this would rely on the market going through a big bear cycle, with the macroeconomic situation being favorable in terms of inflation and interest rates. And we would want to see many of those big companies that are heavily weighted in the S&P 500 to be doing really, really well like they have this year so far. So how many shares would you need to own based on our 3 different price predictions of an S&P 500 fund, whether that's VUSA or VOO, to be able to retire comfortably in 2030? To figure this out, we first have to think about the living costs. So I would say that an individual person, so we're not speaking about a family of 4 or a couple or anything like that, just an individual person would need between £1,800 and £2,500 coming in every single month to be comfortable. Of course, this is going to depend on your lifestyle, and for this model, we're just looking at the UK because that's where I live, and it will definitely depend on whereabouts in the UK you're actually situated. But let's just round this to $2,000 per month. So then we would need to adjust for inflation. So we're going to assume an inflation rate of 5%. Now, the Bank of England have set themselves a target of 2%, but we're not really hitting this at the moment. In my opinion, that's just too low. So we're going to say 5. This would mean that you would need around £3,400 per month in 2030, which is a total withdrawal of £40,800 per year to live on. This is also assuming that you have paid off any debt and your house is paid off as well. The average retirement length right now is around 20 years, so we're going to use that in today's model. If you plan to retire earlier, then just factor that in. It's also really important to consider at what rate the S&P 500 will continue to appreciate, continue to grow post 2030. Now, clearly, it's not a case of every year is exactly the same. Some years go up, some years go down. It just depends on the years that you end up being dealt. But we're going to use our 7% from earlier, which is of course adjusted for inflation. So how much would you actually need to retire in 2030 based on these living costs? Let's have a look at this table I made. So just to explain this table to you really quickly, if you haven't seen the previous videos I made about retiring on Tesla stock or Palantir stock, we basically have the year from 2030 to 2050 listed down the left-hand side. Because like I said, we are using a 20-year retirement period. Then in the next column, we have the amount of money in British pounds. So this figure here, this 530,000, is the pot of money that you would need to have by 2030 to begin your retirement. Then in the next column, we have capital appreciation, which, like we said, we are setting to 7%. We are assuming that on average, this S&P 500 fund that you've got will continue to appreciate by 7% year over year. Then in the next column along, we've got the new balance with growth, which basically accounts for the balance that you have plus that capital appreciation. And then you've got the withdrawal. So these are the expenses that you are withdrawing in order to live each year. And this is going up by 1% per year. And this is because I looked at many studies that basically suggested that throughout your retirement, some years you're going to need more, some years you're going to need less. Maybe some years you're more healthy, you want to do more. Maybe even some years you need to get into a retirement home and that's expensive. Whatever the reason may be. So to account for this, we are going to increase our expenses by 1% every year. And this just helps make our model even more conservative. And then the last column is the amount after withdrawal. So this is what you're left after the capital appreciation and the withdrawal in the year. So let's just walk through a few rows and then you can pause it and look at all this data. So 2030, you come to retire. You have a retirement pot of £530,000. In the first year, you are not going to get any capital appreciation because it has not yet had that whole year to actually appreciate. So this column and this column you can ignore for now. Then you're going to withdraw your £40,800 that you need to actually live on. The amount after withdrawal is here, and then that figure goes into your second year in 2031. This time, you will be getting that 7% capital appreciation. So with that added on, which comes out at about £33,544, you're going to be left with £512,744. Then you're going to withdraw, which is the £40,800 plus the 1%. And then after that, this is the figure you're left with. That then moves into the next year and it keeps doing that all the way up till 2050. What you can see is in 2050, you've not run out of money yet. You've actually got £34,707 left over. Now, of course, this gives you a little bit of a cushion. It doesn't really give you a massive cushion. If some years you're going to need a lot more, then you could end up running out of money a little bit sooner. So perhaps, I know I would want a little bit more money than this, just so I know I'm really safe. But if you do end up using less, then of course the money that you have at the end, you could pass on to loved ones or whatever else. So now this leads on to the question of how many shares you would need to retire in 2030. And this is based on the model that we just looked at. So having 530,000 British pounds in 2030. So let's just take a look at these tables that will walk us through the different price predictions. So bear, bull and expected, and also both VUSA and VU. So in this first table, you can see that we have our bear, expected and bull price predictions for the S&P 500 index itself. But of course, we're not actually investing into that. We are instead investing into an S&P 500 fund, like an ETF or an index fund. So now let's look at this for VU, for you US investors out there. So for our bear case, we are predicting that the VU price per share by 2030 is $403. This would mean that you would need 1,688 shares, which at the current price today would cost you $680,078 or 530,000 British pounds. Moving on to our expected case, you would need 1,052 shares, which would cost you $423,840 or 330,132 pounds. Then for our bullish case, you would need a lot less. You would only need 743 shares if our bullish case was actually going to happen. This would currently cost you $299,347, or translating that into British pounds using the exchange rate as of today, that would be £233,164. Then moving on to VUSA, which is a very, very popular S&P 500 ETF here in the UK for UK investors. Our bearish case would be £65.20p, our expected £104.68, and our bullish £148.20 per share by 2030. So this would mean that for our bear case, you would need 8,126 shares, and this would cost you 530,000 British pounds, which is of course the same amount that we said you would need to actually have at the beginning of 2030. because we're not assuming any growth for our bear case, if you remember. Then for our expected case, you would need 5,063 shares, which would cost you £330,057. And then for our bullish case, you would need to own 3,576 shares of VUSA, which at the current cost today would put you back £233,119. So if you've watched my other two retirement videos where I look at Palantir and Tesla, you will see that it's quite expensive to retire off purely an S&P 500 index fund or ETF compared to those individual stocks, but it is a lot less risky. So it's kind of risk versus reward. Let me know if you own an S&P 500 fund in the comments below. And please remember, this video is not financial advice and it's purely for fun, as we can only really use our assumptions and speculation to get to these price targets. But with that said, thank you so much for watching and I'll see you in another video very shortly.